Well, here we are in second week of June of 2023. I think the economy is going to start just falling apart in the next 60, 90, 120 days. It's going to become very, very evident to it. And I want to know, are you prepared for a bad economic downturn? Because I think the real estate decline and my asset class is going to start probably in Q3 of 2023. It's going to start to become evident. Now it's following right along our timing model. I mean, it is just scary how this is going along with it. It's just, they keep repeating over and over and over again. We've had signpost after signpost after signpost. I'm going to go through a few of them. I don't want to make this a really, really long video. I do want to make you aware that if you have a property for sale, you better get it sold. If you have some in your portfolio that are marginal, that you don't really care to, maybe they're over leveraged, it's time to start thinking of getting rid of them. So you really need to talk to your financial advisor for any equities or bonds. You need to talk to your brokers to see what you're going to do and see if you need to weed out any of these marginal properties. This is the time to do it, because I think maybe by the time you get to September, October, November, you're going to be chasing the market down. And even if you say, well, I don't have much money in it, it's better to take much money, some money, than not take any money at all. And I think that if you decide to keep these properties, you're going to be looking at saving these for 3 to 5 years, probably closer to 5 years before you're going to sell them again, because we're at the end of the cycle. The cycle is completing, and we just need to go and take care of ourselves. So are you prepared for a bad economic downturn? Because I think this could be a fairly severe downturn coming right at us. We've talked about, now, if you want to go look at my other videos, we've been talking about all the statistics. You can see them. This is going to be talking about timing in the real estate asset market today. If you do like my visit, thank you so very much for helping me get my subscriptions. We're up over 1,000. Thank you very much for that. If you do like our videos, please subscribe. We're not going to send you any requests for anything. And if you like, give me a thumbs up. We try and bring you good content. And this content we're talking about is right now, we're talking about the real estate cycle model. And it looks like it's a national figure. Now, real estate is a regional. So I think we're going to have a total downturn, but I don't think it's going to be as severe in some as it could be in others. Now, our market, our model clearly identifies us being very, very close to the top. So if you want to make some money, you don't buy at the top. When it says it's peaking for a reason, means it's not going up anymore. And that's where we are with this cycle. So we've had a really, really good run. We've identified the accumulation phase. We identified the explosive phase. And now we're going to the completion phase. The completion phase is nowhere near as fun as the other two. So let's just talk about what's coming, because I think we have a real estate correction that is going to be a very severe correction. I think that's coming. So here's a couple of reasons. Now, I'm not going to go too terribly much on the economics of it, but I will tell you, we do an awful lot of real estate investing. We have noticed that investors have really slowed down. We have been on a moratorium since Q2 of last year, of 2022. We just thought that the prices of homes didn't justify the investment at that time. Prices have come down since then, so we were justified for it. We are not putting any new money into the marketplace, but we are talking about doing 1031s, because there are many places around the country that you really need to maybe consider moving your investments. So we have noticed nationally investors are really come down and slow down. Now here in Phoenix, they were a pretty good segment. They were from 20 to 25% of the housing stock was being sold to investors, and that was mostly, which is the where we like to place. So, and that would be an entry level. So homes like 1,500, 1,800 square feet, 3-bedroom, 2-bath, 4-bedroom, 2-bath, 2-car garage. And here's one of the reasons, we've talked about this before, is that financing is getting very, very difficult. It's up over 7% currently. Maybe we get a respite and get down a little bit, but it is pretty tough. Underwriting is getting tough. It's going to be even worse if you've got a project going, if you want to do some building, if you're in commercial, industrial, and that's because liquidity, as we've talked before. Look at our other videos. We've talked about the liquidity issues before. We certainly have them. They have not gone away. They're not going to get better anytime soon. I don't see a Fed pivot coming at all. Let me go to my next slide here. So we have noticed here in Phoenix a rate of change because migration has slowed. Now we've seen that change started in Q2 of last year. We started to see a slowdown in the amount of people coming here to Phoenix. We're right next door to California, and the Californians were just pouring over this. But as that pressure from demand starts to come down, you can see this red line that the prices start to mitigate, and we've actually gone negative here. And this is 30, 60 days. This will be 60 days old on our charts. So it's probably even worse than that now. So we saw investors come out. We saw migration slow down. Now here in Phoenix, it's pretty obvious. In July of 2006, we peaked, and in July of 2022, we also peaked. When you look at these peaks, they don't kind of come down a little bit and then start up again and just keep going. That's the end of the cycle. Now, when we get to July of 2022, it's pretty clear. Now, we had to revise this a little bit because that's what happens with data. So we're using Federal Reserve electronic data, and this thing has changed a little bit. We think that this is the first peak is in. I think we're forming the second peak right now. And of course, this is 60 days back, so it may even look even better when we start looking at it. It might be clear that we're looking at. So our call was the Phoenix real estate market first peak, July 2022, clear as a bell for us. That means jeopardy from here on out. Now, when you look at the Maricopa County, now remember when we get into Federal Reserve electronic data, there's all kinds of different categories. So each category has just a slightly different look on these things. So we want to give you all of them. But here during the Great Financial Crisis, it peaked Q1 of 2006. We keep checking all the data, and Q1 2006 is the top. But it didn't start to decline until Q3 of 2007. So it really took like 12 to 15 months before it started going. And then once it started a little slower and slower, and then it waterfalled. And here in Maricopa County, of course, we were the poster child for bad business. I mean, if you're going to talk about bad business, that was us. Here in Phoenix, it was just way out of control. And properties came down about 70%, 66%, I think is what they came down. And at waterfall. So in the Great Financial Crisis, 2009, we were buying properties with our investors at $50 a square foot. We were buying them below cost to build. The lot came free. We were buying below building cost. And so we were buying a 1,500 square foot home for $75,000 here in Phoenix. Now, I don't know if we're going to get down to $50. I think that would be pretty unusual. But I think we're going to get some very discounted prices coming at us very, very soon. So we're going to be talking about that. Now, again, real estate is regional. These assets are regional. Florida, Orlando, Tampa, Miami, what great marketplaces. San Antonio, Dallas, Texas, what a great, great marketplace. And again, you start getting into Phoenix and Arizona, what great marketplaces. We are not going to be impacted anywhere near Chicago and Seattle, San Francisco, Philadelphia. These places could really, really see some really outstanding declines. And if you're there, if you've got investments in these what we're calling endangered cities, you need to talk to your broker. You need to talk to your financial advisor and review these, because if you don't sell them now, you're going to keep them for the next 5 years. So just keep that in mind. Make that decision, but it is a long-term decision, because I think the market is going to be pretty tough for the next, once we get into Q3 of 2023, I think we're going to start seeing some pretty tough sledding. So maybe you're committed to Chicago and saying that's just a great marketplace, but you don't have to. You can do a 1031 exchange, take your investment property out. It makes very, very good business. You don't have a tax event, and you can transfer it to Florida, Texas, or Arizona. It makes really, really good business sense, because they are not going to be impacted anywhere near as these endangered cities. So let me just go to this next slide here a little bit. So when we start talking about Chicago, again, it's very, very clear. You can take a look at these. Look at that. That's like a textbook double peak. March 2006 to April 2007, not quite 12 months. So, I'm sorry, it was 13 months. So from when the first peak came in to the second peak was 13 months. We've got July, and again, that's July 2022. This is June 2023. It's 11 months later. So I think time is running out. If you want to do this, you better do this pretty doggone soon, because time is running out on you. Now, let me go to the next slide. And Seattle, same thing. You can see in July 7th. And here we are in July 2022. And we've already seen that this is the first peak. I think this will be forming the second peak. And right after that second peak, that's when you start seeing the decline. Portland, Oregon, again, a very, very good statistics. August 2006, the first peak is in. July 2007, the second peak is in. That is only 11 months. So, and once it hits that second peak, that's when the decline starts in earnest. Now, and here in Portland, it came in earlier than the rest of the nation. We've identified it for March of 2022. So what's the 11 months forward from March of 2022? That's April. That would be February of 2023. We're overdue. It can really start almost any time. So I'm just not that familiar with Portland, but I would say that they are in a jeopardy period at this point. I would say if you're in Seattle, or Portland, you need to really get on a stick and decide that this is time to go. Whether you're moving your family or an investment property. Again, if you're doing an investment property, it makes absolutely terrific business sense to do a 1031 exchange. If you don't know what that is, it's easy peasy. We can certainly do that for you. I've done hundreds of them, so it's just not a problem. So we start talking about the housing inventory in Phoenix. I'm going to tell you, I was here in the great financial crisis in March of 2005 in the Phoenix Metro. So this would be this Mesa, Phoenix, Scottsdale, and it doesn't take in Maricopa County, all of them, but it takes in most of them. So listings were just about non-existent. So in March of 2005, that was the absolute peak, and there were next to no houses available. There's just a little over 2,900 homes available. And I'm going to tell you, 1 year later, 12 months later, there were 33,000 properties available for sale. So it went up 10 times in 12 months. And within 2 years, we were at 55,000 properties for sale. 54,283 was the peak. And that is how fast it can turn. It can turn on a dime. It can turn fast. And so we're telling you that you are running out of time. If you don't get this done, then keep them. Be prepared. Now, I'm not saying the asset is going to be endangered. It's the debt that's on the asset that causes a problem. And if you're an endangered city, they may never recover. So you just need to talk to your brokers. They will tell you exactly what you need to do. Now, what this is going to do is give you one of the greatest buying opportunities to really change your life. This is an opportunity where you can just make enormous money, because turmoil breeds opportunity, scares the bejeebies out of people, but breeds opportunity. And you are only going to get an opportunity 3 times in your life, just 3. That's all you're going to get. You got one coming at you in the next 24 months probably, and then we'll give you an all clear, but you're going to be scared. You're going to say, I'm not going to do this. No possible way. But we're going to tell you it's in your best interest to do so, even though it's scary. So let me go to my next slide. Let's just talk about what we see. And here's one of the reasons. Not only does it the completion of the cycle, but we also think that the dollar is at risk. The dollar, you just hear this, the dollar is at war. People want to change the dollar, and we have a fairly strong dollar. Now, if you get to be my age, you realize that these things don't stay. So when the dollar gets high, it's not going to stay high. It cycles. So when in Turkey, this is an astounding thing. So Turkey in 2000, January 2000, 1 lira was at par to the dollar. So 1 lira equaled $1. Fast forward 23 years, and it's now 17 lira to the dollar. It's only worth 1/17 of what it was 23 years ago. So now it takes 17 lira to buy what they could buy 23 years ago. And that's what happens when you lose purchasing power on your dollar. So let me just go to this next slide. So here we are with an historical range on the US dollar. Now take a look at this. Now here we are, we peaked in 2005 when I'm sorry, this is 1985 when Volcker made the interest rates so high. Well, the dollar got very, very strong. But down here in 2008 when we had political turmoil, we had lots of economic turmoil. We had interest rates that were destroying the country. We had lots and lots of problems. We had our assets going down, and the US dollar got down to 71. Now, currently it's running right 102, 103, 104, 105. So it could go down 30%. And if the dollar goes down 30%, that means your purchasing power lost 30%. Now, we call that inflation. Now, we are at risk. So the only thing that holds its value are real assets. So that's gold, silver, oil, forest products, lumber, coal, energy, and real estate. So real estate gives you an income while you're preserving your purchasing power. It's just a great inflation tool for yourself. And after all this turmoil, I don't think it'll be over. I think we're going to have problems with the US dollar. Just pay attention to the news. You can see, the powers that be are trying to assault the US dollar. So we need to protect ourselves. Buying real assets will certainly do that. And if you want an income off your real assets, buying real estate, but buying it smart, is just a great opportunity for you. And I think that's what's coming. So not only did it get a great buying opportunity, but I think that we're going to have inflation. And I think afterwards, and of course, whenever you get turmoil, you get a policy response. The economy just starts falling apart. What has been the policy response is just to flood the economy again with money, and real estate should take off again. So I think we have a period of turmoil, but then followed by a really, really good time. I mean, we will do really, really well. So just to take a quick peek at this, I'm going to tell you that here's our timing model. I think July 22 is the peak, first peak. Second peak should be sometime here in Q2, Q3 of 2023. And then I think it starts rolling over. I think it gets to be pretty pronounced by the time you start seeing, we start getting September, October, November, maybe even into January of 2024. And then I think we start seeing a slide. So you need to talk to your broker, see how that works for you, because we have a buying opportunity, but we have a jeopardy period first. Now, you could have a pretty brutal retracement. This is a bubble. I think we could have 30%, could go 60% around the country. Same with the S&P 500. This comes from Charles Hugh Smith. He's done this with our real estate as well. So here's what I'm going to tell you. I'm going to leave you with something positive, because how do you find fulfillment in your life? Happiness will come to you from buying a new car, or lifting an extra 20 pounds at the gym, or getting a new piece of jewelry, or losing 20 pounds, or buying a new outfit, or watching your child walk first. But fulfillment is just personal. This is just something that's inside of you, and fulfillment comes from doing what you love. You can't wait to get up in the morning to go do that. Unfortunately, oftentimes work and having to provide gets in the way. So being financially free allows for that outcome for you to do what is great for you, what you are here to do. It's here to help your family, and you have an opportunity coming at you very, very closely. So here's some rules for you. I would say to you, review your exposure. Talk to your financial advisor. What's your exposure to equities? What's your exposure to bonds? Bonds equivalents as well. What's that exposure? Review all your expenses. If you need ROI, you got to get that expenses under control. And I would pair them as quickly as you can. Bid. Try and get the best you can. I would review my income streams to make sure that they're secure, and what kind of risk that I have. I would do the what if things get bad, how is this going to affect my income streams, including your rentals. I would certainly raise cash. I would get as much cash as I possibly can. I would reduce debt. If I had to refinance, I would certainly do that. I would sell any marginal asset. And if you don't sell them, you need to expect to hold them for 3 to 5 years, probably 5 years. So severe recessions result in stimulus, creating more inflation. So we need to make sure that we cover ourselves on an inflationary. Housing and very, very conservative rentals are absolutely terrific for that. I would say prepare for reduced liquidity. You have to know that we're going to be looking at a uh, more difficult time for underwriting in any of our loans. So if you're doing a big project, just expect that it's going to be more expensive, more cost, and you're going to have more scrutiny. This is just going to be happening. You might get turned down. It's going to really severely limit the economy from that. Liquidity is just a problem. We've talked about this ad infinitum in our other videos. And I would say, we've had four major bank failures. I should think that you should expect more. I would protect my deposits, make sure that you don't go over the final, and keep in mind that if they're FDIC insured, that doesn't mean they have to give you all your money all at once. So nice keeps the money at home, keeps the money in your trading accounts, just the short-term money markets. You might think of going into 30, 60, 90-day T-bills. Talk to your financial advisor, see what you can do with that. We also have some hedging strategies for large portfolios. If you want to hedge your portfolio, give us a call. And I would say look for 2 to 3 years of turbulence. This is something that we just prepare for. We're here to help you in any way we possibly can. I've been through this. Will be my third, maybe my fourth, because I started in 1972. So I'm an old guy, I've seen this stuff before. It's all about the same. We're all going to get through it. We're going to get done, but we want to profit. We want to be able to sleep well at night, and we want to do well. And here's an opportunity. If you've been waiting to juice up your retirement, you've got an opportunity coming to you right away. So this is where you can find me. You can call me here. You can schedule an appointment. We'll talk to your financial advisor. Certainly talk to you and your spouse. We'll talk to you about that. And then just call, set up an appointment. We'll do a consultation with whomever you are. We can do a 3-way conversation. We can do a face-to-face. We can do all that. So I'm here if I can help you in any way possible. My very best to you. Bye-bye now.